What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is August 10th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we're talking about the major upcoming release in these few hours of the CPI numbers, or the Consumer Price Index, coming out of the U.S. Bureau of Labor Statistics. And while it may sound boring, this is incredibly imperative to watch when it comes to understanding where Bitcoin, altcoins, and the broader asset markets are going to move over the coming week. We need to understand what the expectations are, and if we upset in either direction, where price is likely to go. We've got a lot of things to dive into in today's video. I hope you guys will stay tuned for this one, but I did want to share real quick, for those of you who have been longtime viewers of the channel and have gotten to know me over these past few years, I recently did an exclusive series over on our partner Rockfin. They're an exclusive content platform that allows you to get a deeper engagement with some of the content creators you may really like. And I worked on a series. We launched our first episode, and the series is titled The Diaries of DataDash. It's a series that allows you to be able to track my 10-year plus journey in finance, learning about all the ups and downs, the things I haven't gotten to chat about here on the channel. So if you guys are interested in that, check out the link down below in the description where you guys can sign up for Rockfin. It's $9.99 a month. And on top of that, you can watch the intro, see if it feels like it's something you'd be interested in. All right, won't take up any more time. Let's go ahead and kick off the conversation here. Now, as we're stepping into the CPI, Bitcoin has been relatively neutral here for nearly a month now, since as far back here as basically July 19th. And the RSI has started to stall here. We're not seeing the same kind of usual move where we come down here into oversold territory, back into overbought territory, right? Going from risk off to risk on. We haven't seen that yet. Ethereum has started to follow suit as well, starting to push sideways here. While it's making higher lows and higher highs, that momentum is slowing, and momentum is key here. So knowing what we should expect from the CPI numbers is very imperative here, because if we get an upset on the CPI numbers, Bitcoin and Ethereum will likely react to the downside. They will start to have a pretty severe reaction, because I think the market is showcasing signs here that it's waiting for this release. Now, this will come out here really soon, equivalent to this time period, which is on Eastern Standard Time at 8:30 when the release will happen. It's about 6:27 a.m. right now at the time of recording. But essentially, we are going to be getting this release today here, and it is going to be summarizing the numbers for the month of July. Now, again, it's important to note that this is a bit of a lagging indicator, right? It's talking about last month. It's not talking about the current month, where we've continued to see commodity prices go down and the real kind of physical symptoms that you see on a day-to-day basis. So inflation starting to go down a little bit. But I want to go ahead and just talk about expectations here, because it's not just crypto that has started to stall a little bit. We've started to see equities facing some resistance at an expected range here near our target of 13,500, and of course at the 200 EMA here on the daily time frame. This was also where, when we got into this pocket between the orange line, which is the 200 EMA, and the 200-day moving average, this is the standard moving average, right? We saw here that this is where price faced resistance before continuing correcting. So it's a very imperative time to start to understand what we need to expect from the CPI numbers, because again, if there is a major upset, it will likely knock down price. This is what the market's waiting for here, folks. So let's go ahead and talk a little bit about some quick hints here, and then we're going to talk about the actual expectations. First off, we should expect overall, at a minimum, that inflation year over year is going to be at a lower rate of growth than the previous month. That's the first key point to understand. And what's the key driver of this? Well, not only have food prices and other general commodities such as lumber, which play a decent role in the cost of housing, all of these elements and commodities are starting to go down over time. But on top of that as well, we've also got the key drivers here, which are the energy-based commodities, the commodities we utilize to power the grid, power our cars. These commodities like oil and natural gas have generally been lower month over month. We've got the month of June highlighted here versus July, and we can just generally see here from measuring the highs to the lows here, and generally where price has been, whereas price was hanging around $110 a barrel on average here throughout the month of June. Here in the month of July, we've been ranging roughly around $98 to $100. So we already know that month over month, we should see some kind of reduction here, essentially. That's some really good news. Now, when we take a look at natural gas, it's not as forgiving here. We've had a clear double top, which might signal a longer term downtrend going into the preceding months. But at least for now, natural gas is holding up quite high here. And this has to do, obviously, with a lot of the scarcity going on in Eurozone when it comes to energy independence or energy dependence in this matter, with all the issues with Russia. So we have to account that here. And this is having, again, a global weight on the cost of energy, so not just for Europe. Now, if we go ahead and take a look here at some of the data and expectations, right? We've had a little bit of a pullback here for equities over the past few days as people are starting to kind of cool expectations, wait on the sidelines with liquidity, and see whether or not we're going to actually be able to clear through this. Here is the big estimation you should know about. Now, there are a few core metrics we need to talk about. There is the typical headline CPI number, and there's core CPI, okay? So let's go ahead and break these down here. First off, we need to understand that Wall Street economists are expecting that the CPI is going to rise 0.2% for the month of July, following the June 1.3% surge that really, kind of, again, spooked a lot of people when the numbers came out. The annual inflation rate is seen easing to 8.7% from 9.1%, excuse me. So it's important to understand here, even though technically speaking that we are on an annualized basis going down here, right? That is mainly due to the fact of the month over month change. So when you see that CPI number here, when you hear that prices rose, like we did last month, I think it was around 9.1%, that doesn't mean that month over month prices went up 9.1% since the last report from the US Bureau of Labor Statistics. It's the annualized target. So it's taking the percentage increases or decreases over the last 12 months and pointing it out into one single percentage. Now, another important point though is that, however, core inflation, which excludes food and energy prices, which is a big part of the equation, isn't expected to show much moderation. The core CPI is seen rising 0.5% on the month after June's 0.7% rise. The core inflation rate is expected to tick back up to 6.1% from its original 5.9% measured last month, with rising shelter costs as a prime contributor. Now, this is really where I think a lot of the question marks are going to be, because housing data overall, at least from what I found over the past few years, has been relatively delayed unless you really have the on-the-ground smarts and data to work with. The official numbers that come out here for housing prices essentially are things that are going to be a little bit more delayed or only reported on a month or quarterly basis. They're not frequently reported on. So this is where a lot of the guessing work is going to be with these estimates, and we have to see what the official core CPI inflation number is. I think that's what the market's going to be watching, because I think we understand, because of the fuel prices going down, it is inevitable here, and that's why the estimates are so confident here, that energy prices should be going down. A lot of people can speak from experience. They've been at the pump, and they're paying lower prices than they were before. Pretty easy to get to that point after how exacerbated things got, right? So now we're starting to see that cool down and those symptoms, but it's a question of whether or not rent and property prices are going down. There have been some different types of rumors and speculations I've heard going on each end of the stick. But essentially speaking, let's just go ahead and play it safe. We want to stick here to the numbers. Now, if CPI is higher, or the core CPI is higher than the expected, if we get something above 6.1%, something I'm talking like 6.2, 6.3, up to 6.5%, something really far and deviated off of the metric, that is going to spell bad news for equity markets, because that means that the Federal Reserve, the central bank of the United States, and other central banks across the globe are going to have to tighten harder. And the stronger the dollar and the higher the interest rates, that means it is going to be an even stronger weakening factor on equities, and that includes cryptocurrencies as well, all assets abroad. Now, on the other hand, if we get something below 6.1%, if we get, for example, on core CPI, something around 5.5 to 5.75, something that signals that the Fed is still in the driving seat, not just on commodity prices going down, but inflation across the board, even including rentals and properties, due to higher mortgage rates, due to, again, the price of living just getting so expensive over this past year, due to the entrance of new liquidity and higher salaries, right? If we get a lower amount, then that is going to be a really great boon for equity markets, because it's going to mean that the Fed will have to tighten less, and it will give period, even if it's just for a relief rally like we've been going through now, it is at least going to give confidence to the market until the next major macro event, which is the FOMC meeting. That's going to be later in the month of September. But let's just go ahead here and again try to map it out in price. Try to make it a little bit more visual here, because we've been talking about what it's going to be like essentially. But I think it's important to understand where price could likely go. Now, if we get, for example, a really positive report, the core CPI is low, numbers are looking good, cost of living is just generally going down, I think that's how we easily get the setup here for a breakout higher in the NASDAQ 100. And we try to make this range of previous resistance formulated by the last two significant highs, we try to make it support and break past the 200-day MA here, right? This blue line that's going across the chart. We try to see if we can break above there, right? And that's all I would say so far here. And that's leading up here into September, right? Until we get that FOMC meeting from the Fed, where we really get a clear picture as to whether or not the Fed feels like it has inflation under control. I'm going to be honest with you all, I think that is the less likely scenario here. What I think is much more likely to happen is we're either going to get neutral numbers or we're going to get a pullback lower here, right? We're going to have an upset here where inflation is rising still too fast. Even though wage growth might be coming in to help mitigate that, it still means that the Fed would not have cooled inflation. And if anything, we get a breakout here to the 200-day EMA as well as the line of resistance here at around 13,500, and then we chop down lower back into the previous resistance range to try to make it new support. I think that that is the most likely scenario here that we are going to get. Now, if we get a massive upset where core CPI is really just continuing to rise higher here at a rapid rate, we could even collapse as low here as back down to the lows, right? Because this is going to signal here that we are likely in a position where the Fed's hand is forced. It has to raise interest rates to a dramatic degree, and it will likely not just do another 75 basis point hike as it promised, but it's going to probably have to take on the challenge of a 100 basis point hike, something ridiculous that is going to cripple the economy due to the cost of credit getting so expensive. And all the while I make that sound like it's a bad thing. Yes, forcing the economy into a recession obviously isn't fun, but it may very well be necessary. It is likely necessary for us to go through a recession, a temporary cool down that cuts down the demand in the economy to bring back equilibrium between demand and supply that we can provide for, so we can mitigate inflation, so we can bring back trust into the dollar and currencies abroad. And I know that, again, there are some people out there saying, the dollar's going to collapse one day. Look, that may very well happen in our lifetimes. I wouldn't doubt that. But we should not wish for that by any means here, at least not now, because the world has already gone through so much. And if it goes through something that bad, right, that would just be terrible for all of us. We right now want stability in the currencies. We want to reduce inflation. We want to bring back the cost of living to normalized levels so that wages can come back up and bring us back to equilibrium. Now, again, I think overall we're going to get the latter two scenarios here. I think what's more likely is we bump up here again, face resistance, and kind of come on down here towards this range of support. This is the more likely scenario here, at least out of this report today. And who knows, maybe after that we have a secondary retest up here going into the actual FOMC meeting. And if the Fed surprises, all right, with a higher than expected interest rate hike, showing that it doesn't feel like it has a hold on inflation, or it feels like it can be more hawkish and press forward, that is your driving force that's going to drive you down here. So don't expect things to go up in a straight line all at once, nor should we expect them to go straight down all in one move, okay? So that's our general outline here. But again, as we look towards the future here, right, at Bitcoin as well, there's another important point we need to talk about. If Bitcoin, again, is able to hold this range coming out of the CPI number release, if we get the optimistic outcome, right, the core CPI is much lower than expected, that's your call sign for this to really pop up back into the previous capitulation or consolidation range here from $27,500 to around $32,000, and potentially even retest the moving averages here, the 200-day EMA and the 200 day moving average as well. So that's one thing to watch. If we get bad results here, especially considering this weakening RSI here, this will likely be confirmed to be a false breakout here or a failed breakout attempt above the previous range of resistance, and we will fall back in here at a minimum down here towards this ascending line of support. All right, we'll go ahead and draw it over here on the chart. We can see that we've got this potential breakdown to 21,200. That would be the move there if, again, we got that neutral scenario. And then the worst case scenario, if core CPI is really just getting out of hand here, that could be enough of a call sign, essentially, with crypto being a more risk-on market, where we come back down here and have another retest down at this range around $19,000. Don't take it out of the cards, guys. Don't take my drawings at face value, right? I don't have a magic ball. All I'm trying to do is just try to give some understandings about where things could really go and realistically move depending on the core CPI numbers, right? I think the headline number, of course, matters for sure, but I think it's the niche data that's going to be within that core CPI that tells us whether or not the Fed's really able not just to cool consumer demand for energy-based commodities and bring back equilibrium, but also to cool down the cost of living. This is a massive added expense, and it's one that unfortunately we can't really track at the end of the day outside of tracking property prices that get released from time to time as an average, and average rent, all of these kind of metrics that again take time to come out into the equation. So this metric released today is going to be very valuable. I know people sometimes talk bad about CPI numbers and how it's manipulated, and sure, but there's a large degree of manipulation. But we have to understand that markets are going to react whether it's positive or negative. It's just the case scenario we have to consider here. So I'm curious what you guys think about what we just talked about today. Do you guys think that the Fed is going, the U.S. Bureau of Labor Statistics is going to be releasing a number that beats estimations? Essentially, we have a weaker rate of inflation than expected, or is it going to get worse? Are we going down this path of perpetual inflation that really is going to call on the Fed to do something dramatic to cool and rein in inflation? If you guys enjoyed this video, drop a like, leave a comment if you have any thoughts on that question. And until the next video, everyone, where we will have the CPI numbers released, wish you all the best, trade smart, stay safe, and I'll see you all in the next one. Take care, everyone.